So as we start off the webinar today, I figured I would just kind of cover a little bit of the tax laws that kind of have gotten us to where we are today. And also just as an example of the fact that tax laws have been changing pretty regularly over the past, almost 10 years now. So just kind of to start, in the 2017 in December, a lot of tax laws you'll notice will have passed in December. The Tax Cuts and Jobs Act passed, which is what we're going to focus on mostly today. And that's when the income tax rates were dropped for individuals, actually also for businesses, but we're going to be focusing on individual tax rates today. And estate tax rates were almost doubled in 2017, all starting as of January in 2018. And then in 2018, we had a lot of changes in state income and in state tax laws. So it didn't necessarily affect you personally, maybe your state didn't, but other states did because they were trying to coordinate their tax laws with the new federal law. And then in 2019, we saw the Secure Act pass, which I think the biggest outcome of the Secure Act was the change in beneficiary IRAs and no longer being able to stretch RMDs over a lifetime, but instead having to get them out within 10 years. And then when we saw COVID in 2020 and 2021, we saw a lot of stimulus bills that added a lot of temporary tax changes, increased credits, things like that. And then 2022 was a Secure 2.0, which kind of built off of some of the laws that were passed in 2019 with the Secure Act. And then not on here, but what we're going to discuss in more detail today is the fact that in 2026, if nothing changes between now and then, we're going to be going back. A lot of the individual tax cuts and changes in the 2017 Tax Cuts and Jobs Act are going to expire, and we're going to go back to what taxes look like in 2017. So what was in the Tax Cuts and Jobs Act? As I mentioned before, it was passed in December of 2017. So this was a tax law that took place in 2018. It reduced tax rates for individuals. So those of you who found yourself in the 25% tax bracket in 2017 are now probably in the 22% bracket. Those are in the 28% bracket then are probably in the 24% bracket now. So they basically took most of the tax brackets and reduced the tax rates within those brackets. They raised the standard deduction that basically doubled it. So a lot fewer people within these past few years have been itemizing their deductions just because the standard deduction is so much higher. It increased the tax and other dependent tax credits. So some credits you're getting now will probably go away in 2026. It greatly increased the thresholds for the alternative minimum tax. So a lot of people used to have to deal with the AMT in 2017 and before. Not very many people have had to do it within, since 2018. That's probably going to come back into effect in 2026. And then, as I said earlier, the federal exemption, the estate and gift tax exemption, it basically doubled. So really nothing else with the estate taxes changed. We still have the same 40% tax rate, same annual exclusion gifts, but the exemption itself doubled since 2018 through 2025. And then what's changing in 2026? So unfortunately, in order for Congress to be able to pass the law in 2017 to get with 51 votes in the Senate, they had to arrange it in some way so that it didn't negatively affect the federal budget over 10 years. And so a lot of those individual tax brackets and tax changes that happened in 2018 had to expire in order for them to be able to pass it the way they did. So that means the income tax rates and brackets are going to go back to 2017 levels. So again, if you're in the 22% bracket, you're probably going to find yourself back in the 25% bracket. Those in the 24 will find themselves in the 28. The standard deduction is going to drop again. But on the other hand, you can see that there's a limit on state and local income tax deductions right now, which they limit at $10,000 per tax return. That's going to go away. There's going to be no cap anymore. So those of you who live in high income tax states probably going to be able to deduct those again. The AMT exemption is going to drop again. So a lot of you are going to find yourself in AMT, and child and other dependent tax credits are going to go down. And then the federal estate tax exemption amount, that's going to drop roughly in half. So it was around just over $5 million in 2017. It'll still have inflation adjustments in 2026. We're assuming it's dropped somewhere around $7 million again in 2026 if nothing happens. So now I'll pass it on to Joe.
Thanks, Kate. And so I'm going to hit more of the individual tax changes in a little bit more detail than Kate just covered. So at a glance here, you're seeing the income tax rates for individuals. These are individual tax rates. You can see on the current side where the tax rates are lower, line by line at 10, 12, 22, and 24%. So on average, they're about either 2 to 4% lower in comparison to the right chart, which is the Post-Tax and Cut and Jobs Act. So that's the reversion back to the 2017 tax brackets. So on the right-hand side, you'll also notice that the range, or the income ranges are lower, and these on the right-hand side have not yet been fully adjusted for inflation. So we expect them to mirror or get closer to the current income tax rates in the ranges, but we won't know that until 2026. So they should adjust to inflation, but at the very least, when you look at them in comparison, the rates are less in today's income tax chart. So anywhere from 2 to 4%, depending on which bracket that you actually fall into. And then when we talk about long-term capital gains, that's my insurance brain, you can see that there's still the 0, 15, and 20% brackets. And lo and behold, or for the most part, this hasn't really changed. Where you fall on the tax brackets and where your income falls are pretty much in line with the 0 and 15 and 20% that they were in 17, adjusted for inflation. Again, on the right-hand side, we don't know what the adjusted 2026 rates will look like or the brackets will look like, but in the most part, the 0, 15, and 20% capital gains or long-term capital gains rates are going to stick, and not much change is going to happen there. So when we look at the standard deduction, as Kate mentioned earlier, it almost doubled. It more than doubled, actually. And this has been adjusted on the left side for inflation. So right now, if you're married filing jointly, you get over a $29,000 tax standard deduction. And so that really eliminated a lot of people from itemizing their deductions. And it made it simpler to file your tax return. Who it did affect the most are most of the East Coast and West Coast tax filers, because they usually got a pretty large SALT deduction or state and local tax deduction for their property taxes. But that was capped at $10,000 as a couple, or $5,000 per individual. So that significantly impacted the East and West Coast, higher cost of living areas that have high property taxes. And so that will come back. The SALT taxes will come back, and certain itemized deductions like itemizing your investment fees will come back as well in 2026, but you're also losing the larger standard deductions that we've currently experienced. So you'll probably itemize more in 2026. You'll be able to take some of your interest on your primary mortgages and home equity lines up to certain limits that are a little higher than what we have today. So at the end of the day, the itemized deductions will probably help those on the coast, but not so much in the Midwest and the center of the country. And then from the alternate minimum tax, as you know, this was created to kind of tax higher income taxpayers. So there's two ways of calculating what you would owe. And if your regular income tax rules were superseded by the AMT, you would end up paying more in AMT. It was actually in 2017, about 5 million taxpayers were affected by the AMT. And consistently since then, from 2018 to now, about 200,000 taxpayers are affected by the AMT. So that's been that saved a lot of taxpayers money by not having to pay the AMT, but this will come back in 2026. And right now, the estimates are going to be that it'll affect about 9 million different taxpayers. And so when you look at the brackets, the reason why so many have saved on not having to pay the AMT is because the threshold or the exemption phase outs were raised so high, that $1.2 million for married filing jointly. You can see the the exemption amount starting at 133,000 versus the 84,000. So that's actually helped save people on not having to pay the AMT tax as of late. But this will phase out in January of 2026 and could affect up to upwards of 9 million tax filers at that point. So what are some of the things that we could do? We could bring income forward. So think about if you're taking advantage of a traditional 401k, maybe it's worth taking advantage of the Roth 401k option and actually paying the tax on today's income. You might want to take on and maybe liquidate some capital gain positions to pay the tax today versus tomorrow, just based on brackets alone. You might want to take advantage of Roth conversions where you'll pay taxes today in a lower tax bracket, so that you're not in the higher tax bracket tomorrow when you end up withdrawing those IRA or qualified assets. And if you have the option maybe to defer income today, maybe your employer is offering a deferred comp strategy or something of the sort, maybe don't defer that income. Maybe take advantage of liquidating your stock options that you have available today instead of waiting a little longer. So really start thinking about how you could incur more of the income today in the more favorable tax brackets that we have.